Hey, what's up, guys? I'm gonna see if anybody else joins right quick. Just gonna wait a little bit longer. Reagan's, how's that volume profile coming along?
Uh, I've got the strategy builder part of it. I feel like I've got the conditions and all that stuff pretty good, but the problem is that the signal I'm working with is still it's still garbage. I gotta get it where it will use current day's calculated value areas, and right now that indicator I'm using still uses previous day's value areas as targetable plots. So that's what we were working on trying to recode that because it draws current day value areas. It just doesn't plot them. And so we're trying to find where it's storing that data in the code of the indicator and changing that over to a plot that can be targeted strategy builder. And we just haven't been able to successfully do that. Gotten it where I can create new plots within the indicator and where strategy builder can see them and target them, but it's not using the data that I want. You know,
What it might be have something to do with how, like like trying to use a volume profile in real time like that, since it can
so that's
change.
that's also going to be an issue for sure. Trying to back test against something, that changes throughout the day. Whereas every time I've seen and it was an in the morning thing. Like I noticed, like okay, that's where it's calling the value area for now, and that's
Mm.
going to change the day and as the volume and stuff goes. So that's definitely going to be tricky. But even with back testing, the problem is still it's not using the plots that I want it to.
Yeah.
So even in a live forward testing to work out the kinks, it still wouldn't work because it's still not using the signals that I want it to. But like I said, I feel like I got the bones there. It's got to figure out how to get the meat on it now.
I haven't looked yet. You might have, if there's any like paid options out there.
For a value area indicator.
Yeah. First,
Like I said, I did some googling, and all I found was this one that I've been messing with. I haven't seen anything else really pop up, but maybe I'm just not digging deep enough or using the right words.
Well, you are seeing the actual information getting plotted, is what you're saying?
Yeah, so
You're seeing a
it calls
live.
it something. It calls it something different within the indicator. So in the actual coding, it calls it the evolving value area, and what it plots is the value areas from the day before, and then during the current day session, it calls it the evolving value area, which is the exact data that I want as the plottable source. But it's yeah, I haven't figured out how to get it to change that to being one of the targetable plots. The data is all right there. I can see it. I can find what they're calling it. I see the variable. I just don't know how to get it to make that the target.
Yeah, I might be able to help you with that. So, uh, you, yeah, there's like a properties section that you can add, um, basically stuff you can get out of the indicator. But a lot of times you can't call the memory directly because it's a class, so it's protected basically from outside. So there's a way you just kind of like yeah, if you look at the properties section, you should be able to see where you can reference it, like the previous days, and you can see how it's returning, like what it's referencing and what it's returning. So you may be able to just to copy paste the high, low, and POC, and then rename them slightly, and then be able to pick those up. But yeah, I can, if you want to.
well, they're
Yeah,
talking about it a lot over in the NinjaScript channel. That's where Reagan and Flair have been working on it. If you want to,
yeah,
maybe.
Yeah,
I'll take a look. I'll see how things. I don't want to take up the live too much, but yeah, maybe I can
yeah.
help.
Come check it out, and I'll post the latest version of it that I have because I did do that. We're down in the properties. I added making it a public series double so that it can be accessed outside of the indicator. But again, it's like it doesn't seem to be calling the right data. But yeah, this is definitely something that, digging through programming, and like I said, I feel like we're closing in on it. I'm just not getting the correct info there.
Okay, cool. Yeah, I'll see what I can see.
How difficult would it be to add deviations to it, you think? Like if you get to where you can plot that, um, value high the way you want to and do either ATR or a percentage based deviation from those plots?
That would be pretty
It sounds simple to me, but I mean, maybe it's not.
So you might not even need to do that. You could do it within the strategy directly.
Well, the thing about the builder is you have to be able to access those plots, and the builder isn't capable of performing math like that.
Oh, I didn't realize that. Yeah, it wouldn't be too complicated to do that if you had it pretty well done.
It'd be nice if it did, and if you hang out over at the in the Ninja Trader ecosystem forum a lot, there's been just so many requests for so many things with the builder and the strategy analyzer, and the jump from Ninja Trader 7 to 8 was just absolutely massive. Like the difference in just everything. And I think they're going to have, a pretty identical jump from Ninja Trader 8 to Ninja Trader 9. And I'm just stoked for it, to be honest. I think that Ninja Trader 8's been out for several years now. They're really due for an update. See what Rock is saying. Yeah, I meant to mention, if you have the lifetime license and you have access to the volume metric and order flow, then you can just right off the bat use you have access to the volume in any way you want to where you can make indicators off of that. And the formulas for those plots are actually really simple.
Yeah,
But
I have the lifetime license, and same. It shows the data also in a beautiful way, but same thing. It's a drawing. It's not plot, so I can't get the data. And it's not an indicator. But funnily enough, like you can't access it. You can add it as an indicator onto a chart, but it won't let me do it in. It won't let me even say it exists. Strategy Builder, the order flow volume profile indicator.
Yeah, that's strange, to be honest.
Yeah, I think there's maybe one or two of the order flow indicators that can actually be used in Strategy Builder. Unfortunately, order flow VWAP and order flow volume profile are not in that mix.
Exactly the one that has the data that I want.
Yeah, the actually helpful ones. Yeah. I had read that in some support board. I had when I was researching about Ninja Trader Strategy Builder, and quite a flaw.
Yeah, the lack of being able to do stuff with the market internals is definitely a drawback. I think
That's a huge drawback. Oh, I mean, I don't know if something custom can get built, but I mean, I feel like for those would be like great conditions, to build in.
Well, I mean, my kind of opinion on is people really think that using those types of internals, give them a superior advantage. I personally don't think they do once you actually put the data to it. I haven't been able, to put a lot of data to it. I just know all of the, very successful people that I've talked to, don't use elements like that. And the most people that do are the ones who, are really big into scalping and order flow, going for a couple ticks, and that's just a whole different kind of, especially in the quant world, using market internals to make very short-term horizon forecasting models. Like there's a whole nother ball game where those kind of play in. Whereas like I think if we made a trend filter, like prices above the EMA, then we get some cumulative delta order flow divergence for a trigger, then I don't think it would hardly make any bit of a difference compared to the endless triggers we can use that don't use those types of internals.
I think it's maybe most useful as a way of categorizing kind of the market regime of the day, where it's like, you have 3 distributions, or you might have just one big distribution where you might want to use mean reversion versus a trending strategy. So maybe it would fall into kind of more exit targets, or which system to run. Maybe would be useful in that context. I haven't really looked seriously into it. But
Are you
all I know-
speaking about volume profile?
Yeah, volume profile.
Okay, yeah. In that sense, yeah, because I do think there's some value behind a volume profile. I was talking more about order flow.
Like, you mean like reading tape?
No. He's talking about stuff like market breadth or advanced
Oh,
decline,
okay.
or breadth is like the number of volume that's going to up stocks versus down stocks, or stuff like that. And like actually that stuff is really valuable. But I wouldn't challenge Akotic because I don't have data to back that up. But as a discretionary trader, it is very, very valuable, especially when you're like thinking about reversion. I think it's really oversold. There's definitely alpha.
Whenever I traded small caps, you can get a really significant advantage with looking at the level 2 quotes and the order flow on there. And there was a slight advantage. I think one of the drawdowns that it can cause when you're trying to discretionary trade with it is you get too much conviction, because you feel like since you're seeing this happen, that this should happen, and then you get this, you just get too much conviction for your trades, and then that can lead to you just doing, not having enough discipline to say when you're wrong. Because people who use order flow and market internals like that, they are literally using it because they think that they're capable of spotting a specific moment in time where price is more likely to go in their favor than it is to go against them. And from my experience, being able to spot a specific moment in time like that, even with the most like advanced models, is extremely short horizon, which is why the ones who do it and the ones who are best at it, only go for a couple ticks, which, if you trade into treasuries, the amount of, how liquid they are, and if you could accurately scalp, a couple ticks a day, then you're doing great. I mean, nothing against that approach for sure. I know.
Yeah, I mean, I use it pretty successfully, but I think it just depends on where you're at as a trader, to be honest with you. Because
you have to be very disciplined.
Yeah, exactly. I mean, at the end of the day, this kind of goes into like a bit of psychology, which I'll just only say a tad bit. But like at the end of the day, right? Like traders, you have to think, and not in absolutes, but in probabilistic thinking. So there's no absolute in the market, except that we will all win and lose. But I think I know what you mean. But yeah, but you can also say that about any indicator, right? Like, if I don't use these, but if RSI goes to like under 30, crosses back above, MACD, volume weighted MACD is doing the same thing, right? Like those things can give someone confirmation, more confirmation, but like you just have to be aware of that, right? And at the end of the day, right, if it hits your setup, you just have to execute it without thinking if it's going to be a winner or a loser, But that's
for sure.
That's just trading.
That's definitely the right approach. That I guess most traders don't really figure it out until it's too late. Most people either they'll just give up or they'll keep digging and be like, oh well, this is kind of what I was doing wrong. But I think we got everybody that we're going to get on for today. So let me... You see, I titled this one a really cheesy name. I didn't change my bitrate. I forgot to change my bitrate. But the picture should be clear. And if it's not clear, then let me know. So to get a nice clear picture, I had to just capture 1080p and then stream 1080p because my screen's 4K. So what you're actually seeing now is just a part of my screen. But that way it's nice and clear, because for some reason I can't stream in 4K. Whenever I try to stream in 4K to YouTube, it just gives me this error. And 4K is more intensive on my end too whenever I'm trying to also run strategies. But yeah, the super cheesy name is because I want this one to kind of stand out, because pretty quickly all these recorded sessions are gonna, I'm not really putting like descriptive titles of each one just because I don't feel like doing it. So this one will stand out a little bit because we're gonna go over some really important things that I think is very important before we move forward with, you know, this community strategy and future ones. And to do this, I decided to go full on college professor mode, and I made a tiny PowerPoint. And to be honest, I'm terrible with PowerPoints because I have a bad habit of staring at the point that I made without talking about the point. I just like blank out, and then whenever you're live streaming, your mind is already like fuzzy by itself. But I'm gonna do my best here. I wrote more points.
Appreciate the effort.
Yeah. I wrote additional points to remind me of what I'm supposed to talk about whenever the point comes up. So maybe it's gonna work out. So the reason why I made this right off the bat is just because from everything I'm currently seeing unfold in the group, I feel like there is a slight disconnect of the approach, because that's all I'm trying to do here. Okay, I'm trying to create a unified approach to creating systems, because that's the only way, you know, some amazing stuff is going to come about. Versus like a lot of other discords, a lot of forums. I mean, this happens all over the place where, you know, if you get 100 traders in the same room, but they're all kind of, you know, stuck in their own ways or doing their own thing, then there's nothing really is gonna ever come about. Of course, I'm not saying to, you know, not do anything else you want to do. Obviously, I'm just saying, just for this Discord, you know, just for this little Discord server, I want us to have a nice unified approach. Then if you want to, you know, scalp treasuries, do Amazon drop shipping, run your car wash, whatever else, you know, then that's fine. So let me see. So I figured that the reason why there's been a disconnect is maybe it wasn't doing a very good teaching of what's going on. So that's why I made a very short PowerPoint. Just has 4 points, and I'm gonna try to go through it as quickly as possible. So the title of the slide is Focus. Kind of plays on what I was just saying. This kind of needs to narrow our focus on.
Are you screen sharing?
Show what?
But are you screen sharing? I'm not able to see anything on my end
Oh,
for the presentation.
you haven't been here in a while. I do the YouTube live link screen.
Oh, I see. Okay, for
Yeah.
sure. I'll check that. I'll find that out. Thanks.
I posted it in the main chat, and you also find it in the recorded sessions channel where I'm posting all of them. So let me know when you're on there, Sky.
Yep, I'm on. Thanks, man.
Okay, cool. So yeah, the title of the slides, Focus, plays on what I was just saying. Which, like I said, it's not anybody's fault. I feel like it's my fault because I'm just not really, I guess, just getting the message across all the way about this is what we're doing, just for the community strategy, and just, I mean, in general, overall. So the first point is we aren't just building an ORM strategy, okay? We are learning an entire approach to creating a system. And so what that means really is what made me think of this is people are kind of jumping ahead. They're kind of start trying to create other types of orb strategies, and maybe adding, just, I'm not going to be specific, so I don't want anybody to think that I'm like pointing anybody out. But kind of jumping ahead is the best way to put it. Let me go and skip to the next point. So the most crucial step is first figure out a multitude of ways to quantify the pattern using indicators. This will provide us with key information to how the pattern operates. So what that means essentially is, for lack of better words, you can think of these different types of initial tests as kind of like diagnostics to see how the strategy actually operates. And let me see if I still have my notepad. Let me go up here to the paint. And let's just recall now what the pattern was that we're trying to exploit. Draw a line here. So this side is the opening range. Gonna have to mute that NinjaScript channel. It is making some lovely sounds in my ear. Let me just.
My bad. That was me. Sorry. I won't talk. I didn't realize.
Oh, it's fine. It's just like I didn't have it on mute, so it's like a bleep in my ear. So this side is the left of the opening range, and obviously if this is the range, it makes a high. After the opening range is made, our pattern is when price breaks above the opening range. That's our trigger, in hopes that it will have a large uptrend. Okay, so breakout, large uptrend. That is the only pattern that we're trying to exploit. We're not trying to see if we get a better system if we, start in the opening range, and then we break down below, then we cross back above the middle range, then the RSI goes oversold, and then we go back here. Like, no, we're not trying to do all that. We're just looking to see how much we can exploit this pattern when it just breaks above and keeps on going. So all we needed to do was first code our trigger, which was, the break above the opening range. And then all we needed to do was use a simple trailing stop that allows us to hold onto a long trend, which we use with the ATR trailing stop, which kind of looks like this, And so right off the bat, whenever we looked at this initial test, we optimized very slightly the ATR from 2 to 5. Running that test on certain time frames told us key information. And that key information was, if you want to extract the most amount of profit, then you need to allow this amount of pullback or this amount of noise. So if it gave us a 2, if it said the ATR could be on 2 and it gave us the best results, which it did on the higher time frames, then that told us how tight we can have our stop for those uptrends on that higher time frame. Whereas when we dropped the time frame to like the 3-minute and the 2-minute, it told us that, hey, the ATR needs to be a 5 now. And so why is that? It's because there's a lot more noise on the lower time frames. So already we're getting key information. So we ran this initial test, and then we ran some more tests. We ran very slight variations that I did here on a different session. And this variation was so the trigger was the same. Trigger is not changing. These are exits. Changes to our exit. Because with this particular setup, the trigger is pretty much set in stone. Because since it's literally an opening range breakout, the trigger has to be when price breaks above. Now we did try one variation of a trigger. That's where we just introduced a tiny bit of lag to the entry, but that proved to not be superior to just using the break above. Now with these exit variations, it was once we enter, we're just going to hold until the market closes. So it was exit on session close, or we close beneath the high of the range. So it's a dual stop loss. So let me take away that ATR. So if we entered here, we can just pretend that right here was the close price. We would hold till the close, or exit when it closes beneath the opening range. So essentially, if we exit for a loss, it will only be if we close beneath the high of the opening range. That's going to be our exit for a loss. And we're hoping that if we hold it until the close, that's going to extract the most amount of profit. Okay? And that's the part we need to understand about why we're testing this variation. Is we're testing to see what happens more often. And then once we find out what happens the most often, then we can build rules around that. So this variation did terrible. And why is that? Simple. It told us, since this variation did terrible, we know that most of the time when price breaks above the high, it closes back beneath and stops us out.
Did you add any hysteresis or any kind of time-based delay on that?
Say it again.
Did you add any kind of hysteresis? Like, in other words, I mean, if you took an entry anywhere, going long, you want to not immediately stop if it crosses right below your entry price. Is there a delay on when it crosses below the entry price where it would close,
No.
or any kind of fixed? Okay.
So you're right. Right off the bat, just by seeing it, you can be like, well, this is gonna perform like shit, and it did. But we didn't just play off of that assumption. We went ahead and ran those tests. Because who knows, maybe more often than not, price breaks above the opening range and just keeps on going. But unfortunately, that isn't the case. It kept on crossing above, it would get stopped out, it would cross above, it would get stopped out. So that tells us some key information about this pattern. So the next thing we tried was the exact same thing. We're going to hold till the close, hoping we get a big uptrend on the day, and then our exit for a loss is if we close beneath the midline. We got better results, but still didn't improve our original baseline. So that tells us, since we got better results, let's add our midline. That tells us that more often than not, when this pattern occurs, price likes to go above the opening range high, fall back in, but then eventually go in our favor. That is very important information. And the next one we tried was the low, and then we tried the open. I'm skipping ahead here some. And then the next thing we tried was, instead of exiting on close, we're going to exit on our original exit, which was the ATR trailing stop. However, our trailing stop is our exit in the money, and these are still the same as previous. So the close beneath the high, close beneath the mid, and the low and the open, those are going to be our exit for a loss. So what that means is, let's draw this ATR back over here. Let's say we close above the high and we're using the midline as our exit for a loss. That means if price comes down and crosses beneath the ATR, it will not stop us out, because our ATR only gets us out when we're in the money. So we gotta be up here when that occurs. So it allows price to float around, and if it ends up going up, then we'll exit when it crosses beneath the ATR up here. So this is the next variation that we ran. And similarly, with the first variations we ran, the high did the worst, the mid did okay, but the low did by far the best. And so what does that tell us? That tells us, because since we used the midline and it gave us worse results, that tells us that more often than not, when this pattern occurs, price will come down, break beneath the midline, and keep on going. And that's why we got worse results whenever we used the midline. But whenever we used the low as our initial stop, that by far gave us the best baseline. And now that tells us that more often than any of these other occurrences, when this pattern occurs, price loves to fall back in and act like it's at a disco ball, but then eventually go in our favor. So now we have a lot of key information about how this pattern operates. Another thing to note is that our exit in the money worked significantly better whenever we use the ATR trailing stop instead of just holding to the close. So what information does that give us? It tells us that more often than not, when price does go in our favor, maybe it has a midday squeeze, maybe just whatever happens, more often than not, price will retrace significantly later on in the day, giving back enough profit to where holding until the close is not superior to having a tighter stop loss whenever price is moving in our favor. So cool. There are other ways that we could potentially test the initial variations of this pattern, but these are very good ones to start out with, and in my opinion give us all the information we need to know moving forward. So on to our next point. After fully understanding how the pattern operates over a sample size, because unfortunately it is always dependent on our sample size, we can create logical rules to fully exploit it using money management tactics and exit strategies. Now, what does that mean? This is when things get more interesting. We get that away. We just remove that too. Okay, I'll bring it to there. Bring the midline back in. Since we discovered that more often than not, price likes to fall back into this range, specifically below the midline, but not stop us out and eventually go into our favor, then we can create additional rules now that could potentially add to our position whenever it does fall back into this range. We could potentially add, which I'll just put with the blue dot, while it's in the range, or we could say if, after X amount number of bars after our entry, price is inside the range, we could set a variable to true and then set a limit for the top of the range again, so that whenever price comes back to the top of the range and it hasn't stopped us out, we can add to our position. And it's little tiny tweaks like that that can take a strategy from 0 to hero.
So it seems like what you guys have discovered or evaluated, it's extremely similar to what you see on like pretty much all time frames in terms of any strategy operating that's bullish improves the bigger the stop loss relative to the like from an initial state, from the initial entry, like until you kind of hit like the bounds of like where you're, in other words, like if you did inverted risk ratio and you literally just bought the open or bought any random minute of the day with like a 20,000 point stop loss and you took profit, you'd see massive profits most likely, right? So like, is that the edge we're seeing, or is there really a lot of edge value in the fact that it's trending for longer when it crosses the opening break?
Well,
see what I'm saying?
I think,
or have we just not captured where the alpha is in terms of the bullish condition of that opening break actually happens later confirmation wise or statistically. You see what I'm saying?
So there's a couple ways I can approach that question. And so just right off the bat, we could use, since we know that this happens more often than not, we could use, okay, whenever price breaks above the high, then set a variable to true, and then wait for an entry inside the range, risking the low. And in that case, we'd be using the break above the range as a leading indicator. So there's that. But I think what you're referring to is you're thinking like, oh my goodness, if I enter on the high of the range and my stop is the low of the range, then I'm just gonna, be having these enormous risks. A lot of the times, which I've talked about in other sessions, especially discretionary traders, they always want to have these tight little beautiful risks, and they think they can find these entries where they have these tight little beautiful risks. That might be the case with the type of trading I was talking about previously, with the scalping and all that type of stuff. But we're going for large intraday moves. Opening range breakouts have almost endless potential on an intraday scale. And to be honest, all my strategies have that same premise where I do not cap the profit potential. I always leave that uncapped, because if I cap it, then I'm taking away the one benefit that random chance actually gives me. And random chance says that if I exit at even a random point in time, at some point, the market is going to move massively in my favor. And those massive fat tails can really make or break you with a lot of systems. I'm not saying your system needs to be dependent on it, but I never cap my targets. And so another thing, all we look at is the numbers. Like, for example, I was working with one member. It was Reagan with the EMA cross, and I told him that he had a stop loss and some other stuff going on, and I said more than likely you're going to get better results just using the EMA cross, which is when you just enter when the fast crosses the slow, and you exit when the fast crosses the slow back down. Because you're letting the market be as dynamic as it wants. You're not putting these constraints on it. And so if we run this strategy, we run a test, and over 10,000 trades across 20 products, the metrics are the way they need to be, and we don't give a shit where the stop loss is at. All we do is evaluate the drawdowns and drawdown analysis, and we see what amount of capital is needed to hold through these drawdowns. And a lot of times in reality, it's not those tight little pretty stop losses that discretionary traders take. Because in reality, with this type of trading, any time you try to add those little tight stop losses, it will do nothing but destroy the strategy over a large sample size, because you're not accounting for noise, you're not accounting for volatility. All you're doing is seeing a very small sample of trades that you're seeing on the chart, and you're thinking, man, if I would have entered here, I could have, risked the low of that candle. But the moment you try to quantify those stops and test them over a period, it just never works out the way that you want it to. I touched on several different topics there. I don't know if it's exactly what you were going at.
No, I'm definitely on board. I've definitely seen strategies that I've built where you fail to capture the best possible condition because you're worried about the medium bad conditions, I guess is the best way to describe it. And then obviously by buying immediately on the breakout, you're always capturing any breakout of the high.
Yeah, yeah. Well, on that
Um,
topic specifically, I have something
I,
interesting.
I do think that if you've seen this, there may be opportunity to get better entries. But obviously, what you're doing there, if you're adding, it's running a system where you are taking additional entries um, and putting more weight than if it breaks out and never comes back, right?
Yeah,
Uh,
and
yeah.
so, and this might not even improve it. Is the thing. We've evaluated what we've seen happening, and we're going to add. There's so many different ways to potentially exploit this pattern with money management tactics. Will it actually improve the baseline? You know, will not entering on the breakout and saying, okay, cross above the high, set a variable to true, and then wait for a cross above the midline, still risking that low, will that give better results? Most times when I run stuff like that, I haven't tested that variation yet, but if I had to say, I would say it would not give better results. You would get a higher drawdown and less profit. And the reason why that is because obviously your equity, your drawdown resets when you make a new equity high. Okay, everybody knows this. And so the question of the day, obviously, is, the question of every day is always, do I buy the breakout or do I buy a pullback? Once I heard the podcast from Perry Kaufman explain to me why you should always buy the breakout, it was not to me. I don't know why I said me. Explain the podcast. If y'all know who Perry Kaufman is, he wrote the book Trading Systems and Methods. It's one of like the most. It's like the Bible of algorithmic trading. Dude's been trading trends for like since the 50s or some shit. Like he is the OG in a lot of things. But the guy asked him that, do you buy the breakout or the pullback? And Perry has a saying that he calls the fat tails. You heard me say it not too long ago, and it's catchy, so I'll probably say it again in the future. But the fat tail is what the system needs, because I'm speaking for trend systems, and like I said, I allow all my systems to have fat tails. The trend and the fat tail is just the occasional massive win. That's what the fat tail is. Meaning that for the opening range breakout, every now and then it's going to break above that range and just keep on going and never getting the pullback. So if you have a system that first let me say, let's say that a breakout like that only occurs 1 out of 5 times, right? Meaning that if you wait for a pullback, you're going to get your entry 4 out of 5 times. So you might not think you're missing out on too much. But what people fail to realize, though, is that the one time it doesn't come back is the one time you missed that fat tail. And you know it's a fat tail because you never got the pullback. So that's the premise behind buying the breakout and why you really can't afford to not do it. And if you run tests, you'll find that often you'll always get better results. It's dependent on your sample size, of course. That you'll always get better results just buying the breakout. Instead of trying to quantify some sophisticated pullback. In this scenario, we can do both. We can get in, one contract at the breakout. We can add potentially a little bit after, so we get the best of both worlds to a certain degree. There are pros and cons of each approach. And then assess the improvements, see if it actually improves the bottom line across many products. Does it actually make it more robust? Assess the drawdowns. Because I don't know if you were on the last session, but we already had our drawdown or our profit to drawdown ratio up to like 25 in sample, of course. We're going to be changing that anyways. I'm going to start using more sample size because honestly, we only got the ratio that high because the sample size was small. But for the sake of the live stream, but for future setups, I absolutely love making pullback systems. I've probably made every freaking pullback system you can think of, and we'll probably make some with y'all because I just love the idea of pullbacks. Just entering in on just that perfect little pullback, during a large uptrend. But this pattern, I wouldn't, do initial testing with pullbacks because to me it erases the premise. The premise is the breakout and the run. Unfortunately, the breakout and the run just doesn't happen enough. The breakout likes to occur, it likes to fall back into the range, but not break the low, but then eventually go in our favor. Now, I don't think it does it often enough to merit not taking an entry at the breakout, because already just from analyzing a lot of charts with this setup over the past few sessions, I've seen that pretty often it likes to break above that range and keep on going. So let me, why does it do that? It loves to minimize everything. PowerPoint, okay. Another money management tactic I want to look at real quick. Well, actually, I guess I can give my last point first. So the last point on the slide. Exit and money management strategies are the most important factor for trading systems. In almost all scenarios, an edge is created not by how you enter the market, but how you exit it. And I've spoken a lot with members starting out, just talking about the irrelevancy of triggers. If you actually compare triggers in different market regimes, and you put a 1-to-1 risk to reward on it, you'll see that almost none of them give any advantage that's even worthwhile. Because how you exit the market is where you get your edge. How you manage your trade is how you get the edge. Now, obviously, there's always going to be traders who are in search of that perfect entry, and hats off to them. I've moved on to better things in life. I've discovered that all you need to do is work on exiting and quit worrying so damn much on how you are entering the trade. Now, ending on that point, I can talk real quick about another example of some money management approach, and something I've noticed a lot with this pattern, and this is kind of prevalent with a lot of patterns actually, and it kind of falls in line with an approach that a discretionary trader might take. I already talked about this idea when I was making the first opening range breakout strategy. It was like on the first or second session we had. I think I was just making it with, I don't even know who I was making it with, Gonum and someone else. But a lot of times price can break above the opening range high and then go into a consolidation state. And what I proposed is that if after X amount of bars after our entry, or basically just X amount of bars after our entry, get us out for a profit. Doesn't matter what the profit is, or my bad, not get us out, take partial profit. So if we enter with 2 contracts, after X amount of bars, if we're in the money, take off 1 contract. And the result of this is sometimes if we get this a momentous move like we had here and price starts to consolidate, now obviously the market can go both ways. It can fly up or it can start flying down, but we don't know. And for that reason, maybe it glitches up for a second a little bit in the profit, so we take our small profit, and then if it goes back down, stops us out, then we'll hop out. If not, we'll hold on for our win. And then could even create additional money management, saying, of course, if we're X above the profit or X above the range, if there's so many bars and our position quantity is only 1 because we close 1 over here, then we can add back to our position. And honestly, it's crazy how doing these slightest tweaks to your money management, as long as your sample size is significant, can make the most dramatic difference on your system. And that's why so much more focus needs to be put on it. But no, what do people want to do? They want to think, how can I improve the trigger? How can I improve the win rate? How can I add some random filter? It's always the trigger. It's never about how can I just manage my position a little bit better. And the only way we gain any insight to have a logical approach to what might improve our money management is by running those initial tests and seeing how the pattern operates, or else it's just guesswork. And I mean, sure, you can just be guessing all day, but I prefer to just think logically. Don't even have to look at a chart. Just think about the potential outcomes and make rules based around that. Does it mean you'll always be right? Of course. Does it mean you'll increase the baseline? Because like I was telling someone the other day, once you create a simple, robust way to exploit a pattern like this one, just close above the opening range high, use ATR trailing stop as an exit. So basically exploiting the pattern in the simplest form, it's going to be hard to actually beat it without overfitting. And that's always the catch. But that's why we test our initial baseline over our core batch or basket of products. So we test our baseline over 25 products. It needs to be 26. I'm gonna add the Ultra Bond in there. 26 products, because that is our most robust version of our pattern. Nothing's going to be more robust than our core pattern. It might not be the best performing, because that's all from building the core pattern. All we're trying to do is tweak things in the smallest ways that don't take away from the robustness. Like, for example, if we test our core system and it makes money on 13 out of the 26 products, and then we add, you know, whatever, some filter or something, but now it's only, maybe the net profit is higher, but now we're only profitable on 4 products, you know. Given the type of pattern it is, I wouldn't have faith that the rule that I gave it, you know, actually improves the robustness of it. So cool. Let me check something real quick. So moving forward, if we check out, where did I post it at? It was in it was an orb. It was an orb V1.
The Orb V1 at 10:30.
Well, the first thing I posted here. Let me pop it over here. So now, after seeing this video, you might understand more of what I meant behind this message. You know, drop your ideas for potential trigger and exit changes. Be descriptive and explain the premise behind why you think it might improve the trigger or exit. And so this isn't talking about filtering or, you know, like essentially changing the strategy or changing the premise. It was talking about a potential different type of exit that still maintains the core premise. And so, for example, the adjustment that I did, or the idea I tried out for the trigger that I've had success with for other patterns, is using a smoothed price signal. So what that means is sometimes for this opening range, price might, you know, glitch or go up a few ticks, whatever, close barely above the opening range and fall back in, and maybe it does that 2 or 3 times or whatever, and then ends up crashing, in which case we would take a big loss. So I suggested we can try out a smoothed price signal, which I use the Laguerre, one of my favorite filters. And so the Laguerre, you know, has a little bit of lag to it. So there's a very slight lag that would avoid those false signals. We tried it out and it didn't improve it. But this was a solid potential modification because it doesn't change the premise of the strategy. And what I mean by that is it doesn't add any constraints, because if we use this filter, every time an opening range breakout occurs and runs in our favor, we're going to be in on the trade. So it's not constraining anything, but has potential to avoid some of these fake outs. And then I suggested today in the channel that, well, using this slight smoothed signal, did it improve results for our trigger, but would it improve results for our exit? And so what I mean by that is, say we enter here, price falls down here, and it just, you know, barely goes beneath the opening range low, comes on back up, which I'm sure everybody has been in this scenario plenty of times. And seeing how the 30-minute opening range low is a extremely common, it's a, no telling how many traders are looking at this low, the 30-minute opening range low, that it's susceptible to stop hunting by whatever algos. And so maybe using a smooth price signal might avoid those stop outs. But now obviously you can see the potential weakness from this, because now instead of getting stopped out here, you could be getting stopped out even lower. But there's another flip side, is due to the way the Laguerre works. In a lot of cases, the Laguerre will keep on going down, and you'll actually exit on a more advantageous price sometimes, because the price will actually be moving back up whenever the Laguerre crosses below the opening range low. But once again, we don't know if this will improve the bottom line, because it all relies on if this pattern occurs often enough. If this happens all the freaking time, then absolutely using a smooth filter is going to drastically improve results. If it only happens sometimes, then it's not going to improve results. Then it's just going to have us stopping out lower a lot more times than it does saving our trade. However, since this stop loss is kind of big, this is a big potential save. That's if it comes all the way down and gives that little fake out and comes back up and gives us a big win, then that can have a serious result to the bottom line. So it's definitely worth testing out using that little smooth price signal. And I have seen, using these price signals with a little bit of lag, improve results by quite a bit. I can't really think of any potential modifications to the trigger other than that one, simply because it is what it is. It is a breakout trade. So there's only so many ways to quantify a breakout of a specific level. Whereas a pullback, there's just countless ways to quantify a potential pullback. Like, for example, if we had a strategy that had 2 moving averages, and the goal is just, enter long when we cross below the first moving average, then we have this whole space to see some magic in. Whereas this isn't the case for this opening range breakout. So cool, that's pretty much it for that. I don't know if I should go into working a little bit on the orb. I guess I will. So I said I wanted to increase the sample size. So the first thing I want to do is, I'm pretty sure this is our baseline. Let me pull up the builder. orb 3. So the orb 3, okay, it must be this one, the orb 3 base. Cool, I named it as base. Surely that is the one. Orb 3 base. So make sure it is right. Sorry, it's not on the screen. There it is. So price crosses above the opening range high. 1-9-16. My bad, y'all know what that means. Have a time filter from 9 a.m. to 16 to 4 o'clock. My time zone, obviously. And then you see we have when the ATR changes to -1 and P&L is greater than 0, it gets us out. So it basically says we're only going to take this exit condition if we're in the money. Remember, we're using our ATR exit for the money, and then we are using the opening range low as our initial stop. And obviously in the future we can look at tightening our stop loss as the trade is developing, but right now this is our base because we didn't find any core way yet to create a new baseline. So to give us a core test, I'll just go because people have been asking a lot. Normally what I like to do is have 5 years in sample. It depends on time frame too, so these guidelines are still just subject to change. But for this test, what we're going to do is we're going to have, well, I don't even know if I could do it on the live stream is the issue. I don't know if 5 years on the 2 minute while I'm streaming.
Hey, I got a quick question right there. It shows for parameters ATR1, ATR2. What are those? What variable are you changing there?
Yeah, so what you're seeing right now was the orb variation or the orb with additional stuff. So this ATR2 actually doesn't exist right now in this strategy. So for example, this is the builder for the orb 3 base. So I actually need to take that ATR2 out because it's not being used. So that is my bad on that. There we go. So the ATR1, as you know, is the trailing stop, right? Reagan, are you following me?
Oh, no, I wasn't around whenever y'all were setting that. Looking at that right now, like when you pulled up a second ago, what I have looks like what? Watch, pull up your builder and go to your second set. I believe it looks the same right now, so I'm not sure where you put that info, that 3.5.
Your mic is going in and out a lot. Were you referring to the ATR2?
What?
ATR1,
Your second set?
He's saying the ATR1 and ATR2 is a variable input to the multiple of the ATR. If you don't have that as a variable input, you will enter it in the when you add it to that to the condition, and it's hard code. So it's not changeable from the strategy analyzer viewpoint unless you add that variable as an input.
So
I get it. I was just curious what in the ATR
variables.
we're saying inputs and variables a lot, but so the ATR1 is just being used as an input,
I think that's what's throwing him, basically, is if you don't have that ATR1 labeled input, then you have to manually input a hard code value into the strategy builder.
Yeah, I understand that. What I'm saying is, what was it changing in the ATR? Is it the ATR multiplier?
Oh, okay, yes, it is the multiplier.
Yeah.
Yeah, it's just the multiplier, and I keep the ATR at the default 14. That is the for some reason this indicator puts a default ATR at 10, but as most of you probably know, the standard for ATR is 14. So I'm not going to optimize the period because there is simply no point. That's just grounds for overfitting. Whereas I went over previously why I do think slightly tweaking the multiple is very important.
Okay, so that's what you were changing when you were talking about earlier about large time frame. Let you get away with smaller, but small time frame you had to do it larger for noise with
Correct.
the multiple.
Correct.
So that's why you made that an adjustable parameter.
Correct. Absolutely. Because it gives us really it's common knowledge that lower time frames have more noise, but like to always get that confirmation. So like I was saying, I'm gonna post a screenshot of the baseline results, and I'm gonna try to run that test on the live stream and see what happens. So it's gonna be 2015 to 2020. So, of course, common best practice is do the old in-sample out of data or in-sample out of sample approach, which is good. But once we get closer towards deployment, we'll look at a walk forward optimization, which is essentially the best practice for seeing robustness and for seeing if our strategy it's strictly a binary question. It's answering a question for us of whether our strategy will benefit from optimizing on a periodic basis. And you might think, well, that's just overfitting the shit out of it. Actually, the way the walk forward optimization works, it's an even better tool to prevent overfitting versus doing, let's say, 5 years in sample, 2 years out of sample, but we'll get to that. For now, we're going to run this strategy on we're going to try to run this strategy while I'm streaming. We're going to run the ATR from 2 to 5 increments of 0.5, which honestly I'm just going to do 1 to just make it even harder to overfit. But definitely not overfit territory by any means where we're at right now, but just for good measure. Choose our main basket list. I'm going to do the 5 minutes. So we got 2015 to 2020. I'm going to include commission. We're going to aggregate the results because we want the most robust parameter, not the best parameter of each instrument. Maximum net profit. 251. Okay, I'm going to click the magic button. Save my workspace, and this 5 minutes shouldn't be too hard. We're going to find out. But the 2 minute, Ninja Trader might explode. Does anybody know who Liam Weston is?
Hey, that's me.
Ah, okay. No, like several times people have messaged on the YouTube live chat and it has like their real name, and I'm just like, who is that?
Yeah, the not so anonymous.
Yeah.
Just want to say this is the first time I've tuned in. Very interesting stuff.
Awesome, man. I appreciate it. Definitely, I try to not repeat too many. The only things I do repeat are the ones that are like extremely important. Um, for that reason, I highly suggest checking out the other recorded sessions. I know they might be a little uh, monotonous and long, but there is a lot of value there for sure. If you want to just get some popcorn and hang out.
I definitely plan to. I had been meaning to tune in this week, but work, my day job was pretty crazy. So, but yeah, I definitely,
Cool.
based on what I'm hearing so far, I definitely want to get up to speed. I'll say that.
Awesome, man. Sounds good. And just a little, well, if y'all aren't too used to looking at the strategy analyzer, what's kind of happening here is you can see it's making no progress, but what it actually does is this is going to be paraphrasing the shit out of it, but the way it works is it like analyzes all the data first. It then uses like some algorithm to like run across all of it really quickly. So like it'll show this screen a lot. I think the word calculating might change to something else. But this is like, yeah, it's like looking at all the data, and then it does the test, and the way it does that makes it to where it can like run tests a lot faster. Just so you'll have an idea of how this thing works. And another note I wanted to touch on while this is doing its thing, is I'm simply showing y'all, my approach that I've had a lot of success with. I do not want to come off as some know-it-all, because I'm obviously fully aware that there are countless approaches to the market. So just don't ever get that vibe from me. I'm just trying to make, the purpose of me making this Discord, what it was for, is just to have in my mind, I made this approach that works very well for me. So I just thought it'd be cool to have a small community that has a unified approach to where we can all leverage this approach to the fullest extent. That's all I'm trying to accomplish here. You'll never hear me say that anything is like impossible or it can't be done, or that's a shitty way to trade. Like, that's just a naive, closed-minded mindset. And I didn't get to where I am today having that kind of mindset, because I've traded nearly every market, every way you almost can, just countless ways, and I've keeping an open mind and moving on to the next thing, not being afraid to move on to the next thing, has gotten me to where I am. Looks like we are almost there. It shows 5. And you can see overall our baseline for this pattern, let's see, is not profitable on the 5-minute. I like to look at our best performers in Q, which really throughout all these tests have been our best performer across the board. I am really surprised that CL did that good, to be honest. Usually whenever strategies do good on indexes, they just do terrible in energies. Well, not just terrible, but on CL, I usually don't see much correlation there. So we survived the 5-minute test. I'm just going to look at, so we got minus 49K, minus 19K. So that's for our 5-minute. That's on the 5 minutes ATR and 5. And just real quick, I want to see our best performers, because I already know this strategy is going to benefit off of time of day filtering, but once again, this is our baseline. That is just amazing. Look at that. So I just gotta look at that right now, actually.
It really captured the COVID.
Like, yeah, that's another thing we can keep in mind. This is a long only opening range breakout strategy, but I do just want to see where that took place at. I got my analyzer all smushed because so it fit on the screen. Okay, let me just go to trades. And this is one. This isn't what we do at this step. Look at outliers. But I'm just going to do it right now because I'm just so impressed by that outlier. So let's look at our biggest loser and see when it took place. So 2020, 3/16/2020 at 9:45 a.m. 3/16/2020. We can right click our charts and hit show date range. 3/16/2020. You can see some of these ranges are just beautiful for the NQ. And you can also see how this strategy would benefit from a swing trading approach, but I know you guys aren't too interested in that due to the margin, and there are a lot of shitty things that come out of swing trading. But I mean, look at that swing trade there. Like, I mean, so much profit there too. I mean, just a lot of instances. I'm sure we'd find a lot of correlation where when the trade is held all the way to the close price and the ATR, didn't stop it out, that there's a good chance we're going to get continuation. Because that's when you get those multi-day runners, like right here. I mean, good grief. I gotta stop looking at them. Turn this thing into a damn swing strategy. So 3/16, right? 3/16/2020, I think. I just expect to see like a massive opening range that resulted in a loss. Gotta expand this more so I can freaking see it. Three 2020 at 9:45.
It looks like that was a Fed rate cut and release of the program to aid the economy. So that was like big time Fed.
Did you look it
Hey,
up?
Yeah,
you want to
just
find this quicker in the future? Go back to that one trade in the list of trades, and then right click on it and click chart, and it pulls up a window of just the chart of that trade.
Are you shitting me? Dude, I have never known that.
It's
So,
really annoying because you can't do
yeah,
it
go to
from the
trades.
analysis tab, but you can only do it from the trades tab.
So,
Oh, okay. I just pulled it up. That
there,
is
and
so
you
cool,
right to it.
dude. See, I'm already getting value from this room. This is amazing. It's a freaking game changer. No, but so I'm seeing the trade, and from the
Can you
from
move a little left? We can't really see it from the live.
oh wait, yeah, let me pull up my chart. So this is a trade. Doesn't look like anything unusual, but obviously it's perspective on how I have the chart scaled. It was a very volatile day, and price broke above the range a little bit and just sailed on back down. So nothing crazy, nothing unusual essentially, but definitely want some things in place to mitigate these types of losses. So that's just, I mean, that was just a one trade. That didn't cause this entire drawdown, but that is just one hell of a drawdown right there. Turn that shit off when COVID hit, and you would have been all right. Also, I want to check out the time of day analysis. That's exit. Make sure you always change it to entry, because exit doesn't really tell us much. So pretty scattered. I see this a lot. I see 1 p.m. not do well, and then whereas towards close and towards the open is typically better. But that's really honestly the case with most intraday strategies, so you don't really have to overthink it too much. We got CL, but okay. I don't think 5 minutes is going to give us the best results anyways. Let's go ahead and check out the 4 minutes. So it's funny actually, because the strategy from our project 1 is a lot better as of right now. And y'all recall how simple that one was. But that's also, I told y'all to test that out on the 15-minute charts, which you will also find that when it comes to, say, making a strategy that is, has great performance over an actual significant amount of trades and products, that it is way easier to do on higher time frames. And making an intraday strategy once you start putting that kind of sample size on it is it's very difficult actually.
Yeah, I think you see a lot more like correlation of trends at the higher time frames.
Oh,
you
yeah.
see a lot more mean reversion at the lower you go. You see much more mean reversion. So you have to kind of really account for volatility, mean reverting volatility in your trading system. Even if you're trying to capture trends, the smaller you go.
One of the issues, because that's always kind of the idea. I mean, I can account for one point in my life where I had the Bollinger Bands on like a 10 tick chart, and I was like, this is the holy grail. Because like every time I went to it was just like, it looks like you can just scalp the bands all day long. But obviously, like I already know, trying to look at those types of charts in real time, trying to get quality executions, and of course trading costs. That's an extreme. But even if you were to say make a mean reversion strategy on the 1 minute, it is very difficult. It is not. A lot of people like to talk about it, you know. But no one actually has a mean reversion strategy that performs well in, say, the 1 minute time frame over a significant size. Like I was, but that doesn't mean they don't have their place, because as we move forward in this group, you'll see that everything is from a portfolio standpoint. So honestly, it has nothing to do with the individual performance of a strategy. It's how will this strategy benefit this portfolio. And if you watch the podcast I just posted, there's a guy that has his name's like David Bean, Mr. Bean. He gives a perfect example. He has a strategy that he's been running on soybeans, and it's made no money in the past 5 years. But it hasn't been losing money either. It's been rather like a random walk consolidation type deal. And we're talking about the equity curve, not the price action on soybean. His equity curve of soybean has been like a random walk kind of consolidation the past 5 years. But it has significantly helped his portfolio by stabilizing it during drawdowns. And that's all we look to achieve from a portfolio standpoint. And that's I was telling, I think, Flair, that generally mean reversion strategies shine in a portfolio of obviously momentum and trend-based strategies. Because the moment the trend strategy starts to fall off, if you're looking at your portfolio curve, that's all you're looking at, to be honest. You're looking at your portfolio curve until you notice something weird going on, you know. And of course, you might glance at the performance of your individual strategies, but that mean reversion will kick in, and it will stabilize your equity curve, and that's how you get that nice, stable, high, sharp equity curve from having those non-correlated systems. And obviously mean reversion paired with the trend following system is a perfect example of this. The only catch, obviously, because it's never as simple as it sounds, is your risk management and how you go about doing it. Because honestly, all algorithmic traders really do, or all you become eventually, is risk managers. You're just constantly managing your risk in all these different types of strategies. And it can be as simple or as complex as you could possibly make it. But let me, I can draw a little picture, because I am an artist, in case y'all haven't figured out yet. But, you know, let's say we have a trend, and we're just looking at an equity curve. And, you know, let's say we have a trend system that kind of has a performance like this, you know, kind of just like an uptrend. You know, you got a nice uptrend equity curve, but it has pretty significant drawdowns. And I know some of y'all might know exactly where I'm going with this. But for those who don't, say we have a mean reversion equity curve that is kept pretty stagnant whenever it's not doing so well. You know, so maybe it's more like this, but then in these mean reverting times, it can kind of just creep up some, you know. It's kind of doing pretty good, and other times it can kind of creep up some, kind of stay a little more stable. It's still profitable overall, so if you draw, you know, like a line of best fit, then it's still going to be, you know, profitable overall. It's going to be moving in the right direction. Not the best illustration there, but then you look over here on your main equity curve, and it's a lot smoother, you know. And that is the whole point and the biggest advantage of having, you know, different systems. Say you have a momentum system, you know, that or a short strategy system that starts off right here and does pretty bad, but then starts doing a little bit better right here. And you look at all these different strategies and you say, well, this strategy will really fit well in this portfolio because it's gonna do this whenever this happens. So that your portfolio curve and your portfolio metrics, stay consistent and keep producing that average return. And David Bean, the portfolio he was talking about, he has 40 strategies in. And he follows of course he has multiple portfolios, and you often will. So, and he does equity curve trading and drawdown trading, which since we're drawing pictures right now, I can illustrate that. It's heavily off topic, and I don't want you to dive too much into that, but it's something hardly anybody knows about, and you can call it a trick of the trade, to be honest. But the majority of how a lot of people will approach their portfolio risk management is by trading the equity curve. Of course, you can create two equity curves. Okay, so if you have an equity curve like this, you also get a drawdown curve, right? So in this scenario, you could say your drawdown was flat because you're making new highs, and then your drawdown went down some, and then now we're back up to flat, went down some, back up to flat, and say we had like a really big drawdown right here, and then so your drawdown's like really big right there. If you never looked at a drawdown curve, this might look kind of weird to you, but your drawdown curve is essentially looks like an oscillator. So like it has like a zero line. If you create a strategy with an edge, then you will find that your drawdown curve is the best oversold indicator you'll ever use in your life. Meaning you would actually activate your strategy on the dips, so you're creating your own market environment to buy dips on.
So that's basically, essentially, if your strategy is doing really terrible, but if you trust its track record, the worst time is to turn it off when it's doing badly.
Correct. So I'm not going to say that there's no pros and cons to this approach. There's many caveats. Another thing people like to do is, well, this equity curve is a little bit too smooth. Let's add, okay, so first of all, we're talking about the equity curve of individual strategies. Okay, you wouldn't do this with your portfolio curve, because all these tactics I'm talking about is to keep your portfolio curve smooth. So let's say you have 40 individual strategies where you're buying the dips on the drawdown curves. I know it sounds strange, but it is a very good tactic. And another one people like to use is, say you have an equity curve like this of a strategy. So the historical performance of this strategy is very volatile, right? So it would have a pretty low Sharpe ratio. It has pretty volatile moves up and pretty volatile moves down. Well, you could actually plot Bollinger Bands around your equity curve. And you could adjust your position size based on where that curve is within the Bollinger Bands. So let's say you have a condition when equity curve is below, we take 5 contracts. When it's above, we take 2 contracts. a lot of different ways to go about portfolio management and managing multiple strategies. And that's, I mean, obviously I'll be talking to you guys about different ways of doing it, but I would argue and say that's, one of my weaknesses. I'm not like a portfolio management master, and I'm still learning and looking on different. I mean, I think everybody in that field is still learning on different ways to manage their portfolio. If everybody knew how to do it, then or if there was like a best way of doing it, it would be known. But these are very common practices. Looking at drawdown curves, and you'll hear David Bean talking about some of his approaches as well for managing his strategies, when he turns them off, when he turns them on, and just other tactics. But that's why whenever we're looking at the individual performance strategies, all I'm really caring about initially is just like if it's profitable. Like, are we profitable on these products? Just initially, later on you might be a little more stringent. Well, we can see NinjaTrader has had its run. It gets stuck on 99. I'm used to it at this point. But yeah, running an optimization on the 4 minute for 5 years, I can kind of have that effect. Normally, when I start running optimizations like these, I always save my workspace. And a lot of times it will still give us the result eventually like this. So the combined result was, let's see, 51K minus, so it's slightly worse than the 5 minute. So interesting, because whenever we had a lower sample size, the smaller time frame did a little bit better. So right now, 5 minute is still the winner. And I'm gonna go ahead and run this on the 3 and the 2. Not during the stream. I think we've talked about enough, but I will see which time frame gives us the best baseline and then post it in the the orb channel. And honestly, since I ran these other variations on such a small sample size, I really need to run these again with the larger sample size, because now we're getting like almost 20,000 trades, and on the 3 minute and 2 minute it's going to be probably 25-30,000 trades. So yeah, guys, good session, and I will catch y'all in the morning to work on some more orb.
Sounds good. Catch you later.
Cool, I'll see y'all.